Akre ETF. Explained. Chuck Akre's famous compounder fund just became an ETF. What if you could buy into one of the most respected concentrated growth funds on Wall Street? The kind of fund that has compounded wealth for 2 decades, but in a tax-efficient ETF wrapper? Welcome back to the ETF Investor. Today, we are breaking down AKRE, the Akre Focus ETF, the brand new ETF version of Chuck Akre's legendary Akre Focus Fund. Here is the news. On October 27, 2025, Akre Capital Management converted the Akre Focus Fund, one of the largest concentrated growth mutual funds in the country, directly into an ETF. Same team, same strategy, same holdings. New wrapper. As of April 2026, AKRE manages roughly $6.4 billion in assets, making it one of the biggest active equity ETFs on Wall Street. So what does AKRE actually own? Just 22 stocks? This is a high-conviction, concentrated portfolio. The top 5 holdings are Mastercard, Brookfield, Constellation Software, Visa, and Moody's. Together, those 5 make up about half the entire fund. If you like the names, you love AKRE. If you do not, you should probably skip it. The investment philosophy is called the three-legged stool. Akre looks for 3 things in every business. First, a great quality company with a wide moat. Second, capable and shareholder-friendly management. Third, attractive opportunities to reinvest profits at high returns. If a business does not check all 3 boxes, it does not enter the portfolio. This is why you see names like Mastercard, Visa, and Moody's. They are toll booths on global commerce, with high margins and very long runways. Now here's the catch they do not lead with. The expense ratio is 0.98%. That is high for an ETF. Almost 9 times more expensive than a basic S&P 500 fund. You are paying for active management. Whether that is worth it depends on whether you believe Akre's process produces enough alpha to overcome the fee. Performance over the long run has been strong. The Akre strategy has historically beaten the S&P 500 over 15 and 20-year windows. But like every concentrated active fund, it goes through stretches where it lags. Over the past 3 years, AKRE has trailed the broad market because mega-cap technology pulled the index higher, while AKRE stuck to its quality compounders. So this is not a fund you buy for short-term outperformance. You buy it for the long-term compounding story. Why is the conversion to an ETF a big deal? 3 reasons. First, taxes. ETFs are far more tax-efficient than mutual funds because of the in-kind redemption process. Second, transparency. ETF holdings are disclosed daily. Third, liquidity. You can buy or sell AKRE during the trading day at the market price, not just at the end of day net asset value. For long-term holders sitting in the old mutual fund with embedded gains, the conversion was a non-taxable event. Who is this fund for? AKRE is for the investor who believes in active management, wants concentrated exposure to high-quality compounders, and is willing to pay a premium fee for it. It is not for someone looking for cheap broad market exposure or a fund with hundreds of holdings. It is also not for an investor who wants exposure to high-growth tech. Chuck Akre's portfolio is built for steady compounders, not the next NVIDIA. Honest caveat. Concentrated active funds outperform in cycles, and they are out of favor when growth tech leads. If you cannot stomach the fund underperforming for a year or two, this is not your fund, and the 0.98% fee is a real hurdle. If this breakdown helped you understand AKRE, hit like, subscribe, and tell me in the comments which holding you think wins the next decade. Mastercard, Visa, Moody's, Constellation Software, or Brookfield. I read every comment. See you in the next video.